Hey guys, welcome back to the Capital Mindset Show. We're your hosts, Austin and Fabio, and today we have something really interesting for all of you guys. So, Fabio, what are we looking at here today?
Potentially one of the greatest investment opportunities in the market right now. At least that's what everyone's been telling me. From all these finance YouTubers, from bloggers, they're all been telling me that this Alibaba, the Amazon of China, is right now the greatest investment opportunity of potentially our lifetime. And what do you have to say about that real quick?
Well, first and foremost, if anybody ever tells you that a potential investment is the greatest investment of your lifetime, that in case is a reason to be skeptical right off the bat. With anything, you should always do your due diligence. And even
Yes.
then, don't ever assume that any kind of investment could be the investment of a lifetime. But the only way we can really tell is if we run
Yep.
the numbers.
Yep.
So,
And let's take a look at those numbers. All
mhm.
right. So um, let's pull up the Alibaba model right here. All right. So at first, I want to have a conservative approach. And before we looked at this model and to see what Alibaba would return in terms of expectations, I kind of assumed that it would be more or less a buy based on how the share price has been declining recently. And if the business fundamentals are still there, it should return to us that it is a buy. So right now with a very, very low required rate of return at 7%, this is below market average. We can see that you don't have, I wouldn't have to assume much growth in order for it to be a buy for me. I can almost assume a decay of 2% over the next 10 years, and it's almost at a buy price for me. Now, I'm assuming no share dilution at this point, but if I were to assume share dilution, we can see that it kind of rules out a 2% growth rate in terms of the owner's earnings.
Mhm.
But just barely. So it's pretty much there. Even with a share dilution, I would only assume a 2% growth rate, and I'd still be a buy, and I would expect around 7% growth rate. Keep in mind, though, I'm assuming no margin of safety here, and that's not really how I invest. Now, assuming a market average rate of return, you can kind of see that none of this is now applicable, and I think around 10% to 8%. Yeah, around 8%, and we can see that maybe 9% gets us that buy price that I'm looking for. So I can expect around a market average rate of return, assuming this share dilution. And just so everyone knows, I'm assuming the share dilution based on the average Alibaba has diluted shareholders by. I can see that I would be a buyer if I can assume 9%. And if I were to change this to now a 12%, I can see that it's now not a buy at 10%. But if I assume something like a 12, 15, and let's say 20 and 25%, I can see that at a 15% assumed growth rate, I would expect a 12%, even with assuming the share dilution, right?
Mhm.
And it's somewhere between 12, because 12's almost there. So I would kind of consider that a go. But because it's between 12 and 15%, that is the exact sweet spot. Now, at 15%, I would have to assume 20 and above, right? Or between 15 and 20, somewhere around there, where I would be comfortable with saying I could get probably a 15% rate of return over the next 10 years. However, there's not really room for margin of safety. And because what we're about to get into is potentially some of the risks associated with these businesses. And you work in the accounting field. And what are some of your thoughts on the accounting risks of China?
Well, even what we're looking at now with this model and the fact that the numbers are showing us good things. First and foremost, the absolute paramount risk is the fact that all of this is built on assumptions. And
Yeah.
then secondly, probably just as important as the first, is every firm that's a public entity and is listed on the US markets, they have to undergo what's called an audit. And those audit firms have to be registered with an organization that's known as the PCAOB. Now, the issue with Alibaba, especially, is that the Chinese government and the PCAOB cannot reach an agreement despite effort to do so, whereby the Chinese government doesn't allow PCAOB registered firms, usually US auditors, to go in and conduct audits on Chinese companies because they believe that state secrets will be unearthed and this will threaten Chinese sovereignty. So that's also a first and foremost issue. And then it's also the fact too that because of that, I, as an investor, cannot trust the numbers that these Chinese entities are putting out. Because, for example, you had Luckin Coffee book $309 million of fraudulent revenues. So that, in case, is a point for me when looking at this, that is a huge risk that we don't at Capital Mindset see a lot of people talking about right now.
Yeah, I think it's really not highlighted too often, the accounting risk. Now, we can assume, for example, let's assume that Alibaba, all the numbers are correct and the numbers make sense. So the model is telling us more or less that if the numbers are true, it's a buy, if you can buy the business. Now, there's quite a bit of a problem with that statement in and of itself, because we have to really understand this. Well, what are you buying, right?
Mm-hmm.
You're buying a VIE. Now, what is VIE? VIE stands for variable interest entity, right? So this is you. You are the foreign investor. You are buying Alibaba on the New York Stock Exchange. What you're really buying is known as an SPV1. The SPV1 is actually headquartered in the Cayman Islands. It is the listed company. Then that company has a contract with SPV2. SPV2 is listed on Hong Kong. And I'm going to pause here for a moment and explain something, that there has been a tremendous amount of misinformation that when you buy the Hong Kong entity, that you are buying the actual company. This is not true. You are buying an SPV2. The SPV2 has a contract with something called a WFOE. The WFOE has a contract with either the domestic company directly or a contractual arrangement with the PRC individual who owns the actual shares of the domestic company. More often than not, it is this direction from the WFE to the PRC individual and then to the company, rather than directly to the company. So in essence, what you own here is a company that has a contract to a contract to a contract to the actual owner, to the domestic company, right? Mm-hmm. So you do not own the company. Now, what is the historical context of the VIE? Well, the VIE was designed so that shareholders had very few ability to defend themselves in court against the corporation that they supposedly own, because they do not own it. So that's what it was designed to do. So first of all, you're engaging, you're buying something that was designed to do that. Then you have to consider, and this is easy for anyone who's watching to look up, the difference between property law and contractual law. And if you do this, you search contractual law versus property law, you will see that property law has stronger protections than contractual law, right? And that's assuming that you're just within the jurisdiction of the United States or any other Western country, or many other countries. But in this case, you have different jurisdictions that are kind of in charge here, right? So you own something that is listed in the Cayman Islands. And going off of what you were saying, how did the Chinese companies get away with not being audited yet being listed on the New York Stock Exchange? Well, because technically speaking, the only thing that you're auditing, or the United States is auditing, is the SPV1. They're not auditing the SPV2. If you go back to that link, you can see that they mention Hong Kong as well, but they're not. Hong Kong is not listed in the New York Stock Exchange, so they can't audit these, and they can't audit these because these are on mainland China. So basically, they can only audit this, right? Mm-hmm. They can't go down this chain and audit this company over here. So technically speaking, these companies were not breaking the rules. There was like a little loophole from which the VIE structure allowed them to be listed on the New York Stock Exchange without being beholden to the same auditing standards as other companies. So a lot of people do not fully comprehend that they do not own the business. And that is one of the basic fundamental rules of investing. You own businesses, right? And sometimes it's the basics that we forget that get us into trouble. So going forward, we should also note that there have been a couple of scandals in the past, especially with the one we're talking about, Alibaba, right?
That especially take advantage of this loophole that you're essentially saying.
Yeah, and awesome. What do you think that the Chinese companies get from this VIE structure? Like, what is the benefit of it?
So basically, they're raising capital with almost no downside to be completely honest. They don't have to give an ownership stake in the companies that they're raising capital for. They're in essence raising capital for free on the backs of US investors. And
Or yeah,
I mean, yeah, that's
global
basically
investors.
what I'm looking at. Yeah, global investors. That's what I'm looking at here. At least that's where my logic is going with here, which feel free to correct me if my logic is incorrect.
No, it's absolutely right. And I think you were discussing with me prior to this meeting that something about Russia, right? You're saying that, there's an
Yeah,
argument going around.
so basically, there's a huge argument kind of in favor of the people that are bullish on China currently, whereby they say that, you know, the post-Soviet Union collapse, 1998, 2 decades ago, there was a lot of money to be made investing in that that they then extrapolate from there and they put onto China saying there's a lot of money to be made in here as well. What would be your opinion or criticisms of that potential argument, Fabio?
Yeah, with that argument, I agree that that was the case for Russia. And even today, I still have some shares of my Gazprom investment, which is a Russian gas company. And I understand that Russia has a huge stigma in terms of its political dealings and sort of the system they have going on there. But everything has a price. I firmly believe that everything has a point where it is a buy. And I can discount certain risks. But the problem is I can't discount risk for something I can't own to begin with. There's no discounting to be done. I can't own it. So with these VIEs, they don't represent anything towards the end company. Like there is a point, if I could own Baba directly, I could discount the political risk. That's not really the problem. The problem is I can't own the business. Russian companies, you could own the shares. You had access to own the actual shares. There was none of this VIE nonsense. Now, if I could, again, own the Chinese shares, I could discount the political risk of Xi Jinping at any moment's notice doing something, blah, 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 right? That's not the issue. Everything can be discounted. But the problem is if you can't discount it to begin with because you do not own it, right? And
so there's, go.
Well, there's that one thing that happened that people kind of forget is that Alibaba scandal in the early 2010s with Ant Financial involving SoftBank and Yahoo, right? So what went on there is we can kind of talk about that. Is Yahoo controlled around 40+% of the business, right? 43%. But despite that, they seemingly had no control over the business. And this is a screenshot from a Reuters report. Now, mind you, if you look this up for yourselves, those who are watching, you have to be very clear on Google or whatever your search engine you're using as to what it is you're searching for. You got to look for the year, which is around 2011. And even then, it can be quite difficult to find. But there's the Financial Times that reported on it. There's a Reuters report on this. There was a bunch of reports back in the day. And it was very easy to find in 2017. But seemingly today, for some reason, it's kind of difficult to find. But basically, Alibaba did the equivalent of, for example, if we used Amazon as kind of an analogy, Jeff Bezos taking AWS away from Amazon without compensating shareholders, just taking it, right? So Jack Ma did that with Ant Financial, which is, if anyone knows what Ant Financial is, it's one of the largest payment systems in the entire world, and for sure the one in China. And Yahoo, which owned 43% of the VIE, to I think right here, the Reuters surprise that they owned 43% and they seemingly had no control over what the business was doing. Because, as we know now, they didn't own anything. They own nothing. They just owned a contract to a contract to a contract. What control do they possibly have? Now, for Alibaba's interest, it was in their best interest to not allow this to blow over in terms of like making it so that no one has confidence in their VIE structure. Because if that happened, then they lose that thing we were just talking about, where it's a win and lose for everyone else, but it's a win for them. It's a win every single time. They would love for this situation to continue indefinitely, where they can raise capital indefinitely and without giving up ownership. I mean, morality aside, I think anyone would do that for their own business. You're basically getting free capital to grow your business. And if we were to quickly take a look back at the model here, it's showing me here that if we round that down, let's round that down to 1%. they've been getting about 4 billion. So if we round that down to 400 billion, round this down to -1%, they've been getting about 4 billion a year in capital. And mind you that the market cap was higher before. So they were actually getting more money for their shares. So greater than $4 billion a year to invest in their business without giving up ownership in the actual business. That's fantastic. For those who actually own the shares, that's like really good.
Yeah.
They're able to do stuff that other companies can just dream of, right?
Mm-hmm.
So we were also discussing something about some more recent U.S. action, right? What are your thoughts on what they've done, Congress?
So Congress actually, with bipartisan support, I believe in December of 2020, passed a law that basically stated that any Chinese exchange that was listed on US markets, they had to comply with the US auditing procedures. They had to basically, in essence, allow the United States to come in and audit these companies. Otherwise, they would be delisted. And now they had 3 years to do this. And my kind of question to you, Fabio, is what are some of the risks to investors inherent with this? Let's say that a company does not comply with this legislation, assuming this legislation goes through. A company does not comply with this legislation. What are some of the risks here that American investors might face? Would they just lose their investment? Worst case scenario? I don't know. So
yeah, so if this law stands and it's not like revoked or anything, what we can kind of see here is potentially a situation where you lose the SPV1. The SPV1 will be gone, but you're depending on the broker, will be able to transfer you over to the SPV2. So you still won't own the underlying company, the domestic company, but you'll own this part of the VIE, the SPV2. At least you'll be a little closer to the actual entity. What that will affect on the stock price or the stock price will probably be pretty devastating, in my opinion, because functionally how stocks go up is there's a greater amount of buyers than sellers, and then stock prices go down when there's a greater degree of sellers than buyers. So the amount of entities that will no longer be able to buy, we're talking index funds, pension funds, local investors who just simply don't want to bother with the headache of investing in the Hong Kong Stock Exchange, all those buyers will be gone. And that will either lead to them dumping the shares because it's leaving the exchange, or simply put, that there just won't be as many buyers to begin with, right? And that could have an effect for a while. I think the end result would be China will still have the VIE structure open and available to those who want to buy them, and will still be able to issue these contracts, right? Not shares, contracts, in order to raise capital through the Hong Kong Stock Exchange. So it'll still be a win for them because they control Hong Kong. So they'll still be able to get that access to that Western capital. Granted, to a lesser degree than they would have otherwise been able to if they were listed in the NYSE. But I don't think investors are going to lose their VIE if they really wanted to stick to it. But what we're discussing here is that the VIE is the equivalent of just buying a piece of paper.
It's crazy. It's absolutely mind-blowing. So there's also a common thesis that those that are bullish on China as a whole, they point towards all these big billionaire investors that have billions of dollars worth of capital. They have access to some of the brightest minds in the finance world, guys like Charlie Munger, for example. And how are they not seeing the risks that are posed here with owning these VIEs? How are they not seeing this, Fabio?
Well, that argument's pretty interesting because all we can point to is the 2008 financial crisis, where a lot of these experts came onto television and claimed that, for example, the housing market was the best market in the world. It wouldn't go down. People would never stop paying their mortgages. So all these institutions with all these advisors, right? They can make these mistakes. They can very much make these mistakes. And I got to talk real quick about ARK Invest, right? So Cathie Wood, she's changed her mind, but for, I believe, seemingly the wrong reasons. Everything, again, can be discounted. The political risk can be discounted. Those who are investing in China, they have that right? They're saying that the political risk, it can be discounted, and that's true. However, fundamentally, it matters whether or not you can own it. And if you can't own it, you can't discount it. And that's where they're wrong. They're wrong on that. Okay. It's a very basic rule that oftentimes experts, they can forget the basics. And the basics being buy businesses, own businesses, be a business owner. And if you can't be a business owner, you're not really investing.
Mm-hmm.
So that's what I have to think about with that whole argument with the billionaires. This guy's investing in, and first of all, if you're investing with that kind of mindset, you should be very careful. You should always do your due diligence. Always do your own due diligence.
Always.
If you're not comfortable investing in a business, you shouldn't be owning it, because you're gonna make a mistake. You're gonna make a mistake because when the business goes down, you're not gonna understand why it went down. When the business goes up, you're probably gonna think you're a genius and you got lucky, right? And you're gonna make a mistake because you're gonna go into the next investment thinking that you're this genius investor, and you're not going to fully understand what's going on, and you're going to lose your shirt. And then you're going to blame the world and not yourself for lack of due diligence. So never invest based on what others doing. And you don't know when they're going to get out. The thing is, when we look at the 13F filing, you don't know exactly when they get out. Things could change. They might realize something and then they're out, and you'll find out later. So with Kathy Wood, going back to her real quick, she had access to this information about the VIE, and so does everyone. But people are sleeping on it. Very few investing professionals are even acknowledging this, and we just got the SEC to acknowledge that.
Actually, the SEC actually posted a new disclosure, funny enough, that requires that any companies listed on the US stock exchange from China need to disclose in the notes of their financial statements the risks that Beijing poses in their business, in essence. So
yeah, and I have it pulled up here, the letter from the chairman, and he's basically discussing right here the variable interest entities to raise money in exchanges. Many Chinese operating companies are structured as variable interest entities. So the SEC is always slow to the game, but they're finally catching on. And we've been discussing about this scandal for a while. And
for
just
months,
for anyone who's interested, we're going to post an article we wrote a while back about the VIE entities before these Chinese stocks were collapsing. And we went into detail on the risk, and it'll be for free on our website, capitalmindset.org. So I don't know, man. It gets to me a little bit because I think a lot of retail investors are just being sucked into this, and they have no idea, just like the CDOs, like the CDOs back in the day where, it was the obvious investment, and you're supposed to be fearful when others are greedy. And I implore everyone watching this video to go look it up, go find YouTubers and find bloggers who are saying that China's uninvestable. No, everyone's saying the opposite. Everyone's saying buy now. Alibaba's a steal. It's a great investment. Very few, and even the ones who are more or less bearish, well, not bearish per se, but pointing out risk, they're pointing out the wrong kind of risk. Like Kathy Wood is pointing out the wrong kind of risk. Right? Like I am not adverse to investing in political risk. Again, like I've invested in Russia before, I've invested in India, I've invested in a bunch of other countries that aren't considered to be as strong in terms of their protections on investors as Western countries. You can discount that, but you cannot discount something you can't own.
Yeah, it's very, very true. And that's kind of the purpose of this entire channel, and the reason why me and Fabio started this. We want to just present the facts as objectively as possible without any special interests. And that's what we hope that we've done here today. So if you've liked what you've seen today, feel free to subscribe, leave us a comment, critique us, whatever you would like. You can contact us with any video ideas. We do have to say, for full disclosure, we are not registered financial advisors, and this is for entertainment purposes. So thank you guys. Thank you for coming to the Capital Mindset Show, and we look forward to seeing you guys again.